Hello, my name is Chen, co-portfolio manager of the Allianz Global Artificial Intelligence Fund. It's been an interesting year managing the fund with many new challenges and opportunities. As we review 2021 from a year-to-date perspective, the financial markets has been resilient with the support of accommodating monetary policies from many central banks, gradual but uneven progress against the coronavirus, and strengthening demand coupled with continued supply chain disruption, driving improvements in economic activity and a robust recovery in corporate earnings. Although market volatility has been relatively muted, and most major indices have appreciated, the underlying cross-currents has driven short periods of swings between opposing factors. For instance, growth versus value, large versus small, and beta versus defensive. These market swings have buffered the portfolio's relative returns through the course of the year, but positioning adjustments have helped to steady the performance. Our portfolio adjustments have been relatively modest throughout the year, however. We have found, though, that more attractive opportunities outside the technology sector and have greater representation in the AI-enabled industries when compared to prior years. Specifically, we have increased exposure in healthcare, financial services, and industrial sectors where innovative companies are seeing early benefits from their AI investments. More recently, the investment community shifted their focus on the prospects of potential policy change at the U.S. Federal Reserve, particularly around the removal of quantitative easing accommodation through the tapering process. The idea of QE taper is well known and is expected that it will be communicated well in advance by the central bank. In addition, there remain several evolving factors that could ultimately impact the timing of QE taper. The resurgence of coronavirus within the Delta variant has reduced consumer confidence and more recently impacted the pace of reopening. And separately, the slowing of the China economy along with new government regulations have also impacted views towards global growth. Finally, the discussion of U.S. infrastructure spending has also need to be weighed into consideration. We have constructed a portfolio that allows our investors to fully participate in the strengthening cycle of innovation brought about by advancement in AI, while also managing against the risk and opportunities created by the current dynamic economic environment. We have weighed these considerations for some time in our portfolio construction process, and as such, have made relatively modest and no major changes as we head into the second half of 2021. We continue to take a balanced approach in portfolio construction by identifying AI-related companies that are aggressively investing for disruptive growth, as well as those companies making the necessary investment in the adoption of AI for enhancement of their competitiveness and to drive long-term growth and profitability. As such, the portfolio maintains exposure in both technology and non-technology companies with secular and cyclical growth characteristics. As the journey continues, we are witnessing the strengthening innovation cycle led by AI that will favor companies able to deliver above-average growth. In summary, we believe that we are at the very early stages of massive disruptive change brought on by advancement in AI and the deployment of AI, which will have long-term implications across many industries. While it's expected that at certain times the market may question the underpinnings of this growth, we believe the compounding effect from AI disruption will create long-term shareholder value. Moreover, we believe that stock picking will be imperative to capturing the benefits of this opportunity, especially in an environment characterized by disruption and change.
Allianz Global Investors.